GLD and SLV are both administered by JP Morgan and BlackRock. JP Morgan paid the largest fine the Justice Department ever handed out at that point. And if the sub-custodian's metal does not meet London good delivery standards, i.e. lead bar painted gold, they are not responsible for it. You are paying a 28% collectible capital gains rate when you sell it. What about PHYS and PSLV, the Sprott funds? Eric is a friend of mine. Delivery is a 400-ounce gold bar, which you have to go to the RCM to pick up, or 10 1,000-ounce silver bars. Correct. They sold the gold back to the Fed and then bought in 3 or 4 tranches. All of the gold that they had at the New York Fed, it's gone. But that follows the Dutch Bank, the Bank of Austria, the Bundesbank, Hungary, Turkey, Poland, the Czech National Bank. All of these banks brought their gold back from the Bank of England and the New York Fed, which would give great ease in trading on COMEX and the LBMA. They would rather forego the easy transaction in favor of having no counterparty risk.
India banks are giving loans at 85% LTV on silver. Why is the United States not doing that?
Well, saving your wealth in dollars is like holding a melting ice cube.
Do you guys have any part of your metals portfolio as an ETC, or do you not trust paper silver?
I think he means ETF.
I think that's exactly
C by F on the keyboard. Yeah, it's right above it.
Right
below it. No, ETFs are the worst thing in the world.
Tell them why.
Well, GLD and SLV are both administered by JP Morgan and BlackRock. JP Morgan paid the largest fine the Justice Department ever handed out at that point, $920 million for manipulating the market. You can never take possession of GLD or SLV. It's a paper representation of the metals market. If you read the prospectus, I think it's page 6 through 12, called Risk Factors, it'll say things such as the custodian, JP, is not responsible for the heirs and or omissions of the sub-custodians, who they do reserve the right to employ sub-custodians. They are not entitled to visit the premises of the sub-custodian vaults. And if the sub-custodian's metal does not meet London good delivery standards, i.e. lead bar painted gold, they are not responsible for it. You are paying a 28% collectible capital gains rate when you sell it. You can never take possession of it. You're paying BlackRock and JP a 50 basis point management fee. Do I need to say anything?
Need I say more? Yeah, and again, we don't know. Again, if a default happens with COMEX, or something leads to a disaster when it comes to that, do we know what happens?
No.
Do we want to know?
Some would say, what about PHYS and PSLV, the Sprott funds? Eric is a friend of mine.
The real issue here is not silver exposure, but who actually controls the claim behind it. As Andy Schectman points out here, many investors believe a ticker symbol gives them direct ownership, when in practice they only own a financial promise, layered with custodians, fees, and legal exemptions. That distinction matters more during stress because paper products can behave very differently from the metal they are meant to track. The 2020 liquidity shock already showed how quickly pricing disconnects can emerge when confidence weakens. Next, Andy Schectman discusses why counterparty risk often stays invisible until the system is already under pressure.
As is his daughter, Larissa. The family is amazing, but they don't own the company anymore. It's public. It's their name.
There is a huge difference between, Sprott and SLV.
Well, right, but Sprott is PSLV and PHYS. They're closed-end funds, so you are eligible for capital gains taxes on that, not the collectible rate.
You can take delivery.
But the delivery is a 400-ounce gold bar, which you have to go to the RCM to pick up, or 10 1,000-ounce silver bars. Correct. Good luck on both. Yes. It's not practical. You're paying a 40 basis management fee. Instead, own the real thing. You could store it in a Brinks facility for less than that, and deduct the storage fees, which are tax deductible.
That is true. God, such an intelligent man. It's unbelievable.
I can't remember to zip up my zipper.
And the label in the back of your shorts.
My shirt, is it sticking out?
No, you're good from there. We have a glint question. Made in the young. I don't know.
Easy for you to say.
My eyes and sorry. I'm holding silver in hand. Should I trade my silver from Glint for gold to have access to it with the debit card? Glint is not. They're not doing silver yet.
Glint, you can buy silver. It's not transactional yet. So if you wanted to transact it, then the answer is yes. It is a taxable event. You bought it at a higher rate and you sell it and buy gold, you will get a loss that you can write off against future gains.
All right, here's a good one. Nancy Paulino, 1553. What's the least amount of gold you should own? What are your thoughts on obtaining fractional gold to beat DCA, which is dollar cost averaging? I will tell you, Andy's answer is you want to put into gold whatever you don't want to lose. That is it. Whatever you want to not see go to nothing, because the dollar is depreciating daily and it's evaporating. So that's the answer that I always got.
Let it be your form of savings.
That's
It's
it.
wealth. It's not an investment.
And trust me from someone who has been there, that asked Andy 7 years ago, whatever the case may be, when I first started, what should I buy and how often should I buy and what should I buy? And now looking back at my portfolio, the greatest thing that he has ever done for me, he's done a lot of great things, don't get me wrong. But looking at my portfolio, I can't thank him enough. And all he did was tell me to just buy every 2 weeks.
The laws of compounding, and thank you for saying that. The laws of compounding are an amazing thing when they work for you instead of against you, as they do for most people in this country. And saving your wealth in dollars is like holding a melting ice cube. You're better off holding, just like Catherine Austin Fitz does, just enough dollars to transact. Keep your wealth in assets that are liquid, like gold and silver are.
What sounds flexible on paper often becomes impractical the moment an investor wants real access. As Andy Schectman points out here, some closed-end funds offer better tax treatment, yet the delivery thresholds themselves make redemption unrealistic for most ordinary holders. That means many people still mistake optional access for usable access, especially when minimum bar sizes sit far beyond retail reach. Dollar cost averaging into hard assets can reduce timing risk, but only if the investor understands whether the structure truly matches the goal. Next, Andy Schectman talks about why convenience can quietly become the most expensive compromise in precious metals ownership.
Now, there is a modicum of risk. I understand that. But so too is holding the dollar. It's just a question of what's going to fall further and faster.
All right. Well, let's get a couple more in and then we're good. How does Warsh play? And does he really matter? 1 vote out of 12 FOMC voting members. It doesn't matter. Simply gold.
He doesn't matter because the Genius Act says that all money movement will be backed by short-term treasuries. All money moving, whether you're buying a pack of cigarettes or a new house, will be backed by stablecoins, backed by 90-day or less treasuries, which will pin synthetically the short end of the curve to the floor. So the Fed's mandate is to, with the interest rates, is the federal funds rate, the overnight lending rate, which will be pinned to the floor synthetically. His ability to deal with interest rates will be nil. And as far as, their maximum employment, look, the bottom line, money creation is something the Fed will still do, but the Genius Act will have something to say about that too. I think Trump would not have brought him up for approval if that had not already been discussed. Bottom line is that he wants to clean up the Fed's balance sheet. You can still try and do that without raising rates tremendously. And the short end of the curve will be controlled by the Genius Act. We'll see what happens to the long end of the bond. I don't think the bond market, I don't think the Fed has anything to do about that. So he might establish a little bit of credibility now.
Sometimes the bigger shift is not rates themselves, but who quietly loses control over them. As Andy Schectman points out here, if payment systems become increasingly tied to short-term treasury collateral, the Federal Reserve may have less influence over the front end of the curve than investors assume today. Markets usually price policy power before the public notices that policy power has changed. That matters because bond investors still treat every Fed vote as decisive even when structural liquidity may be driving the direction underneath. Next, Andy Schectman discusses why credibility may soon matter more than traditional central bank authority.
He didn't do very well, I thought, in his questioning by the Senate, so we'll see if he even gets confirmed. Personally, I hope he doesn't get confirmed and they bring Judy Shelton on, but I guess we'll see. I don't think he'll have much of an impact at all.
India banks are giving loans at 85% LTV on silver. Why is the United States not doing
Well,
that?
and not only that, so India, a lot of times when these people would need to come up with liquidity, they would sell their silver, which would then be sold back into the global market,
Yep.
right? So now the banks are required to hold it. It's like going to a pawn shop. They can't rehypothecate the collateralized silver. You have to be able to pay off your loan and get your jewelry or your bars back. So it's why isn't the U.S. doing it? Because the U.S. is several steps behind, because what gold and silver represent are the antithesis to the system. So it's what's okay for the government ain't so okay for the people yet. Maybe that changes.
The United States doesn't even fully recognize silver and gold as a quality collateral in many banks.
No banks will.
There are some that actually take it,
but some will. But it is a tier one.
It's the exception to the rule. It's not the rule itself.
You look at Wells Fargo, who built its reputation on carrying gold through the stagecoach,
right.
Way back when. And I once took part in a $20 gold piece hoard that they all, or PCGS, Wells Fargo hoard, came out of safe deposit boxes from, way back when. Their roots are in gold, yet they wouldn't know gold coin if it fell on their foot. Yet they do have one of the largest derivative positions in the gold market.
Yep.
The system is slanted to keep us all prisoner in dollar and dollar-based assets until it doesn't.
The contrast here is not really about silver, but about what different banking systems choose to recognize as money. As Andy Schectman points out here, Indian lenders treating silver as collateral at 85% loan to value exposes how differently physical assets can be viewed outside the Western banking model. In the United States, major institutions often trade metal exposure aggressively while still discouraging clients from seeing bullion as usable balance sheet strength. That contradiction says more about financial control than about asset quality itself. Next, Andy Schectman unravels why some banking systems embrace collateral that others still prefer to marginalize.
All of the metal that once was, for example, look what France just did. France just they didn't take back all their metal, they did, but they sold it to the Fed and repurchased it because the metal that they supposedly have been holding at Fort Knox is coin melt from the 30s. Therefore, it's not 24 karat, it's 20 or 22 karat, I guess it would be, from the old $20 gold pieces, and those don't meet
the requirements,
24 karat international requirements. So they sold the gold back to the Fed and then bought in 3 or 4 tranches. All of the gold that they had at the New York Fed, it's gone. But that follows the Dutch Bank, the Bank of Austria, the Bundesbank, Hungary, Turkey, Poland, the Czech National Bank. All of these banks brought their gold back from the Bank of England and the New York Fed, which would give great ease in trading on COMEX and the LBMA. They would rather forego the easy transaction in favor of having no counterparty risk. We're seeing this everywhere. Treasury yields rise. We don't trust the Treasury. Dollars being sold. We don't trust the dollar. We don't trust the markets. And so removal of counterparty risk is not a dumb thing. And when you watch David Rogers' Webb, the great taking, the changing of the Universal Commercial Code, which stood court challenges in the 2008 great financial crisis, nothing else really matters. And so, we may be crazy, but I sleep very well at night.
What matters here is not the gold itself, but why so many countries suddenly want it closer to home. As Andy Schectman points out here, central banks are willingly sacrificing trading convenience because counterparty trust is becoming more valuable than market efficiency. Since 2022, multiple sovereign institutions have accelerated repatriation, and that usually happens when confidence in custodial systems starts quietly eroding. Investors should notice that governments often act before public narratives change because balance sheet protection always comes first. Next, Andy Schectman discusses why distrust in paper promises is spreading far beyond the precious metals market.
Yeah, and
I think they have a better chance of being ripped off by the system than
what about the $500 million that the United States has held hostage from the Iran's petroleum revenue, their oil revenue?
That I don't know.
And again, why is it important? Why is having that counterparty risk important? Because where can these countries now put money where they don't have to worry about it being held hostage?
Well, we proved that. We crossed that Rubicon when we confiscated almost $5 billion in Russian treasuries, right, and gave it largely in the form of weapons to the Ukraine, a country they're in the middle of a hot war against. You can't be judge, jury, and executioner. You mentioned Iran. We've been in Iraq for 23 years under false pretenses. We're still there. And until just recently, Iraq hasn't even been able to control their oil revenue. It's been held at the New York Fed. Yeah. And at the end of 23, they asked the U.S. for $1 billion. And they said, no, it's a bad time. Come back after the first of the year. And at that point, they made trading in dollars illegal. They made holding dollar bills in any bank illegal. The world is sick and tired of the hegemony of the West that's rules globally don't apply to themselves. That they can go into Iraq, destroy the country under false pretenses, no harm, no foul.
The deeper warning here is that reserve assets are no longer being viewed as politically neutral. As Andy Schectman points out here, once nations see foreign-held funds frozen or redirected, every treasury account begins to carry a political premium that never existed before. That changes behavior, because countries managing billions do not wait for headlines before reassessing custody risk. For ordinary investors, the same principle applies because ownership only matters when access remains unquestioned during stress. Next, Andy Schectman unravels how financial sanctions may be accelerating a much larger shift away from dollar dependence.
But Russia does what Russia does for their own reasons. This is not any declaration on either of these wars or any pronouncement, but they do what they do, and the U.S. can say, no, you're out of SWIFT, your treasuries are frozen, you're done. And any country that trades with you will be sanctioned. That doesn't go over well to the rest of the world. This is why the BRICS have become the BRICS.
And that was what, 300 billion that we held from Russia? What was the number?
It was between 3 and 5 billion.
3 and 5 billion. And what did the Treasury Secretary of Russia do? They put 25% of the remainder in gold, and over the course of time, made more money than we had lost by the United States taking that money.
It's ironic.
Yeah.
Who is benefiting more than Russia right now? All of the Gulf states, they can't get their oil out, but Russia is selling their oil to countries like China and the rest of the world with no problem.
None.
There's also something called the North-South Corridor, which is Russia's largely financing, and it's an inland sea route and train tracks and roads that go basically from Russia through Russia, Iran, and all the way up to India, which the U.S. Navy doesn't patrol. They're finding alternative routes. This is something that is happening slowly, and the people who comment on this are not able to deal with how long and drawn out this is.
The market rarely prizes geopolitical shifts until the alternative systems already exist. As Andy Schectman points out here, financial pressure can force nations to build new payment channels, trade routes, and reserve strategies that reduce reliance on legacy Western infrastructure. What looks slow today can become structural tomorrow because trade patterns tend to change gradually, before suddenly appearing permanent. Long-term investors should watch capital flows, not just headlines, because infrastructure often reveals where confidence is moving first. Next, Andy Schectman talks about why these slow changes may eventually reshape how global capital is stored.
So they dismiss it as being a nothing burger. The U.S. will never lose its supremacy, but this is not something you can do very quickly or all at once, or the ramifications and consequences are too severe. You do it slowly, then bang, you flip the switch and say, okay, now what are you going to do about it? So we're not there yet, but you can see the pieces being put into place. You don't want to be reactive to this stuff. You must be proactive, even if everyone tells you you're an idiot, and that you have to trust your gut. And that's the truth, because mainstream and traditional financial advisors will not understand this. And I will ask you all this question. If the people managing your money do not see the world the way that you do, should they be managing your money? If they think you're crazy, but you think they're crazy for not knowing, why are they managing your money? I'm just saying.
100%.
To me, it makes no sense.
The biggest portfolio risks usually build quietly, while consensus keeps calling them impossible. As Andy Schectman points out here, systemic change rarely arrives as one dramatic event because financial power often shifts through small moves that seem disconnected until they suddenly form a pattern. Investors who wait for universal agreement are often reacting after assets have already repriced. That is why strategy matters more than prediction, especially when conventional advisors still anchor decisions to an older financial framework.